You open your phone, you check the national debt clock, and the number doesn't just shock you anymore. It doesn't even surprise you. $38 trillion. 38.4 trillion to be exact. That's $112,881 for every single person in this country. $284,914 for every household. And while you're reading this, it just went up another $70,843. That happened in 1 second. In the time it takes you to exhale, the United States government added enough debt to buy a luxury car. And here's the part that should terrify you. Nobody in power is even pretending they're going to pay it back. They're not planning to cut spending. They're not planning to raise enough taxes. They have a different plan entirely, and that plan involves making your money worth less so their debt costs less. Welcome to the most sophisticated theft in human history, and you're the mark. My name is Alex, and for the last 8 years, I've been studying monetary policy, fiscal crises, and the mathematical gymnastics governments use when they've borrowed themselves into a corner they can't escape. I make it my mission to decode the financial manipulation that most people never see coming until it's already destroyed their savings. If understanding how empires quietly default on their promises while pretending everything is fine sounds valuable to you, make sure to hit that subscribe button and give this video a thumbs up. The United States is defaulting on its debt right now, not with a dramatic announcement, not with missed payments or a crashed bond market. This is a slow, polite, bureaucratic default, and by the time most people realize what happened, their purchasing power will be gone. What I'm about to show you is the playbook, the exact mechanism they're using, the historical precedent that proves it works, and most importantly, what it means for your money and your future. Because the $38 trillion debt isn't going to disappear, but the value of your dollars absolutely will. Let's start with where we actually are, because the numbers are worse than most people realize. As of December 2025, total gross national debt stands at $38.4 trillion. That debt is increasing $6.12 billion per day. $255 million per hour, $70,843 per second. In 2025 alone, the debt increased by $2.23 trillion. That makes 2025 the third consecutive year where the United States added over $2 trillion in debt. The debt limit was raised to $41.1 trillion in July 2025. We're on track to hit that ceiling faster than anyone in Congress wants to admit. But here's where it gets truly dangerous. In fiscal year 2025, interest payments on the national debt hit $970 billion. That's not the debt itself, that's just the interest. $970 billion is now the third largest expenditure in the entire federal budget, behind only Social Security and Medicare. For the second consecutive year, interest payments exceeded national defense spending. Defense got $917 billion. Interest got $970 billion. We are now spending more money on interest than we spend on the military, veterans benefits, education, transportation, and agriculture combined. Interest payments on the debt surpassed $1 trillion for the first time in fiscal year 2025 when you include certain accounting measures. The Congressional Budget Office projects that by 2035, annual interest will hit $1.8 trillion under baseline assumptions. Under adverse scenarios where interest rates stay elevated, that number could reach $2.2 trillion. Interest now consumes 19% of all federal revenue. Think about that. Nearly 1 out of every $5 the government collects in taxes goes straight to interest payments. Not roads, not schools, not defense, just interest on money already spent. Now here's the thing nobody in Washington wants to say out loud. The government cannot cut its way out of this. Mandatory spending, Social Security, Medicare, Medicaid, that's locked in. It grows automatically every year. Discretionary spending, defense, education, infrastructure, that's only about 30% of the budget. You could abolish the entire military tomorrow and you still wouldn't close the deficit. You could eliminate every federal agency, every program, every dollar of discretionary spending, and you'd still be running a deficit because of mandatory spending and interest. The math doesn't work. And raising taxes enough to close the gap? You'd have to double the effective tax rate on most Americans. Politically impossible. No one gets re-elected on that platform, so the government is stuck. It cannot cut spending. It cannot raise taxes enough. But the debt keeps growing, and the interest on that debt keeps growing faster. This creates what's called a debt spiral. The government must issue new debt just to pay the interest on the old debt. Each new dollar of debt adds more interest, which requires more new debt, which adds more interest. It's an exponential feedback loop, and there are only three ways out. Option 1 is austerity. Slash spending, raise taxes, run surpluses, and pay down the debt over decades. That's what the textbooks say you're supposed to do. It's also political suicide and economic catastrophe. The last time the US ran a sustained surplus was the late 1990s, and even that was brief and based on a stock market bubble. True austerity of the scale needed to address $38 trillion would require eliminating Social Security, Medicare, defense, and doubling taxes all at the same time. You'd have riots in the streets before you pass the first bill. Option 1 is off the table. Option 2 is explicit default. The nuclear option. Just stop paying. Announce to the world that US Treasuries, the asset that underpins the entire global financial system, are worthless. This would collapse international trade overnight. The dollar would lose reserve currency status. Banks holding treasuries would become insolvent. The global financial system, which runs on the assumption that US debt is risk-free, would implode. This is the end of the world scenario. And while some people think this is inevitable, governments avoid it at all costs because it destroys their ability to ever borrow again. Option 2 is the last resort, which brings us to option 3, the soft default, the quiet theft. Financial repression. This is the path every over-leveraged empire in history has chosen when faced with unpayable debt. From ancient Rome debasing their currency to Weimar Germany printing their way out of World War I reparations to post-war Britain inflating away their World War II debt. It's the same playbook. And it's the playbook the United States is using right now. Here's how it works. You can't make the debt disappear, but you can make the debt shrink relative to everything else by making the currency worth less. If you owe $38 trillion today and inflation runs hot for a decade, that $38 trillion becomes easier to pay back because the dollars you're using to pay it are worth less than the dollars you borrowed. You're repaying the debt with cheaper money. It's a slow-motion default. And the genius of it, from the government's perspective, is that most people don't understand it's happening. They just notice that everything costs more and their paycheck doesn't go as far. They blame corporations, they blame greed, they blame supply chains. They don't realize the value of the currency itself is being systematically destroyed. What I'm about to show you next is the thing that took me years to fully understand, because they don't teach this in economics classes and financial media pretends it didn't happen. But it did happen. And it worked. And they're doing it again. After World War II, the United States had a debt problem that makes today's numbers look tame by comparison. In 1946, US debt hit 106 to 113% of gross domestic product, depending on how you measure it. That's roughly the same debt to GDP ratio we have today. The country had borrowed staggering amounts to finance the war, and everyone assumed we'd be paying off that debt for generations, except we didn't. By 1974, the debt to GDP ratio had fallen to 23%. The debt didn't disappear. It was still there in nominal terms, but it had shrunk to almost nothing relative to the size of the economy. For decades, the official story was that we grew our way out of the debt. That economic expansion was so strong that GDP grew faster than the debt, and the ratio naturally came down. That story is taught in textbooks. Politicians reference it in speeches, and it's mostly a lie. In 2024, two economists at the International Monetary Fund, Julian Acolin and Lawrence Ball, published a working paper titled, "Did the US Really Grow Out of Its World War II Debt?" They went back and did the actual math. Of the 83 percentage point decline in the debt to GDP ratio from 1946 to 1974, only a small portion came from real economic growth. The majority, 51 percentage points, came from a combination of primary budget surpluses and interest rate distortions. Interest rate distortions. That's the polite academic term for financial repression. Here's what actually happened. From 1942 until the Treasury Fed Accord of March 1951, the Federal Reserve pegged interest rates artificially low. Treasury bills were capped at 0.375%. Long-term bonds were capped at 2.5%. The government forced rates down and kept them there. Inflation during this period fluctuated, but it often ran higher than the interest rates on government bonds. That created negative real interest rates. If inflation is 4% and your bond pays 2.5%, you're losing 1.5% per year in purchasing power. And if you're the government, that's exactly what you want. because the debt you owe is being eroded by inflation faster than the interest accumulates. Carmen Reinhart and Belen Sprancia studied this phenomenon in their 2015 paper, The Liquidation of Government Debt. They found that from 1945 to 1980, real interest rates in the United States were negative roughly half the time. During that period, the annual debt liquidation via negative real rates averaged 3 to 4% of GDP for the US and the UK. 3 to 4% of GDP per year. Compounded over a decade, that's 30 to 40% of GDP just evaporating from the debt burden without the government ever making a single extra payment. This is financial repression. You keep interest rates below inflation. Savers lose purchasing power. Bondholders lose purchasing power. But the government's debt becomes easier to manage. It's a wealth transfer. From creditors to debtors, from citizens to the state. And it's the exact strategy being deployed right now. If you've made it this far, you're already ahead of 90% of people who have no idea this mechanism even exists. But don't stop now, because what comes next is the modern toolkit. The specific tools they're using today that make the post-war playbook look primitive by comparison. Tool number 1 is captive buyers. Back in the 1940s, they used legal requirements and patriotic pressure to get Americans to buy war bonds. Today, it's much more sophisticated. It's called regulatory capture. Basel III regulations, the international banking standards adopted after the 2008 financial crisis, designate U.S. Treasuries as high-quality liquid assets. Banks are legally required to hold a certain percentage of their balance sheets in these assets to satisfy liquidity coverage ratios. Pension funds, insurance companies, and money market funds are all either required or incentivized by regulation to hold treasuries. This creates artificial demand. It doesn't matter if treasuries are a good investment. It doesn't matter if the yields are terrible. Financial institutions have to buy them anyway. The government has essentially turned the entire financial system into a captive buyer of its own debt. Your pension fund isn't buying treasuries because they're a smart bet. It's buying them because the rules say it has to. Tool number 2 is the broken compass. CPI manipulation. If you want to run inflation higher than interest rates without causing panic, you need the official inflation number to look lower than it actually is. And that's exactly what's been done. Since the 1980s, the methodology for calculating the Consumer Price Index has been rewritten multiple times in ways that systematically suppress the reported number. Substitution bias is one method. If the price of steak goes up, the CPI assumes consumers will switch to hamburger and tracks the hamburger price instead. You're getting less for your money, but the CPI doesn't call that inflation. It calls it a substitution. Hedonic adjustments are another trick. If a new car costs $5,000 more than last year's model, but has a backup camera and better fuel efficiency, the Bureau of Labor Statistics adjusts the price downward to account for the quality improvement. On paper, the car got cheaper. In reality, you're paying $5,000 more. These changes save the government billions of dollars on Social Security cost of living adjustments and Treasury inflation, protected securities payments. But more importantly, they let the Federal Reserve and the Treasury claim inflation is under control while your grocery bill doubles. Tool number 3 is fiscal dominance. This is when the Federal Reserve loses its independence and becomes an enabler of Treasury spending. The Fed is supposed to control inflation and maintain the value of the currency. But when the government is running trillion-dollar deficits and issuing debt faster than the market can absorb, the Fed faces a choice. Let interest rates rise to the level where private buyers actually want the debt, which would cause rates to spike and crash the economy, or step in as the buyer of last resort. The Fed chooses option 2. This is quantitative easing. The Fed creates new money out of thin air and uses it to buy treasuries that nobody else wants. This suppresses yields and keeps borrowing costs low for the government, but it floods the financial system with new dollars. Those dollars don't just sit in a vault. They flow into asset markets. Stocks, real estate, commodities. Prices inflate, and this brings us to one of the most important and least understood concepts in all of monetary economics, the Cantillon Effect. Named after 18th century economist Richard Cantillon, this is the observation that new money does not enter the economy uniformly. It enters through specific channels, and the people closest to those channels benefit first and most. When the Federal Reserve prints money through quantitative easing, where does that money go first? It goes to the financial sector. Goldman Sachs, JP Morgan, BlackRock, hedge funds and investment banks. They get access to freshly printed money at near zero interest rates. And what do they do with it? They buy assets, stocks, real estate, corporate bonds, art, luxury goods. They buy before prices rise. By the time that money trickles down to wages, to paychecks, to the average worker, prices have already increased. The asset owners got rich. The wage earners got inflation. This is why we have a K-shaped economy. Since 2008, the wealth of the top 10% has exploded. Stock portfolios quintupled. Real estate in major cities doubled or tripled. Meanwhile, real wages for the bottom 90% have stagnated or declined. The median American cannot afford the median home in most cities. Savings accounts earn 4% while real inflation runs at 6 to 8%. The middle class is being liquidated. The national debt is being paid not with tax revenue, but by destroying the purchasing power of everyone who holds dollars and works for wages. This is the trade. The government gets to keep spending. The financial elite get richer, and you get poorer, slowly, quietly, year after year. Now let me tie all of this together, because when you see how these pieces connect, everything changes. The $38 trillion debt, the $970 billion in interest payments, the captive buyers, the CPI manipulation, the Fed printing money to buy treasuries, the Cantillon Effect. These aren't separate problems, they're parts of the same system. A system designed to transfer wealth from savers and wage earners to the government and asset owners. Financial repression is official policy. It's not a conspiracy. It's in the research papers. It's in the Federal Reserve's own minutes. They just don't call it theft. They call it macroprudential policy. They call it accommodation. They call it supporting the recovery. But the effect is the same. Your dollars buy less every year, and the debt becomes easier to manage. Here's the hard truth that might sting a little. The traditional advice you were given, save 10% of your income, buy bonds, build a 60-40 portfolio, that advice was designed for a world where money held its value. That world no longer exists. Under financial repression, saving in cash is financial suicide. A savings account that earns 4% interest while real inflation runs at 6 to 8% is losing you 2 to 4% per year in purchasing power. You're paying the government for the privilege of holding dollars. Government bonds are even worse. A 10-year treasury yielding 4% when inflation is running 6% means you're locking in a 2% annual loss for a decade. This is by design. The government has turned the traditional safe assets into wealth destruction machines. To merely preserve your purchasing power, you're forced into risk assets. Stocks, real estate, commodities, Bitcoin, alternatives. You have to speculate just to stand still. The economy has become a casino where you must gamble to survive because the safe option is deliberately destroyed. And here's where it gets even darker. There's a fourth tool on the horizon that would make all of this exponentially more powerful. Central bank digital currency. A digital dollar. Right now, physical cash is the ultimate check on government power. If you don't trust the banking system, you can pull out cash and hold it. It's anonymous. It's outside the system. It allows an exit. A central bank digital currency removes that exit. Every dollar would be digital. Every dollar would be tracked. Every transaction would be monitored. And here's the key part. A CBDC allows for programmable money. The government could implement negative interest rates directly. Your account balance could be debited 1% per month automatically to force you to spend. They could put expiration dates on stimulus payments. You have 30 days to spend this or it disappears. They could restrict what you're allowed to buy. No purchasing of foreign currency, no transfers over a certain amount without approval. This isn't theoretical. China has already rolled out a digital yuan with many of these features. The European Central Bank is piloting a digital euro. The Federal Reserve has published research papers on digital dollar architecture. They call it innovation. They call it convenience. But it's a control mechanism. And if you think financial repression is bad now, wait until they can program your money to lose value automatically and prevent you from opting out. We're in the home stretch, and I've saved something important for the end. Because everything I just explained, the debt spiral, the financial repression, the wealth transfer, it all sounds abstract until you realize what it means for you personally. So let's make it concrete. If you hold dollars in cash or bonds, you are being taxed through inflation at a rate higher than any official tax. If you work for wages and your raises don't keep up with real inflation, you're getting a pay cut every year, even if your nominal salary goes up. If you're trying to save for retirement using traditional methods, you're running on a treadmill that's speeding up. The finish line is moving away from you faster than you can run toward it. The American dream of working hard, saving money, and retiring comfortably is mathematically dead under this system. It no longer works. The rules changed, and nobody sent you a memo. So what do? You stop holding assets that can be printed. You start holding assets that are scarce. Real estate that generates income. Productive businesses. Gold and silver. Bitcoin. Skills that create value. Anything that cannot be inflated away by a government printing press. The winners in this system are people who own scarce assets. The losers are people who trust that currency will hold its value and that institutions will act in their interest. The $38 trillion debt will never be repaid in real terms. It's going to be inflated away. And your dollars are going with it unless you move them into something real. The Federal Reserve knows this. The Treasury knows this. Every economist who studies sovereign debt knows this. They're not going to tell you. They're going to keep saying inflation is transitory. They're going to keep saying the economy is strong. They're going to keep saying your savings are safe. And while they're saying that, they're going to keep printing. They're going to keep borrowing. And they're going to keep transferring your wealth to themselves. This is the $38 trillion time bomb. And the fuse has been burning for decades. You're not going to see a dramatic explosion. You're going to see your rent double, your groceries triple, your paycheck by half of what it used to, and by the time most people realize what happened, it'll be too late to move their wealth to safety. But you're not most people. Because you're still here, you made it to the end. Which means you're serious about understanding how this system actually works. Silver, gold, the Fed, inflation, taxes, real estate, Bitcoin. What's the next topic you want me to dig into? Drop it in the comments. If there's a financial topic keeping you up at night, tell me. That's what this channel is for. Your future millionaire self is counting on you to make the right move now, before the crowd figures it out. The debt won't disappear, but your purchasing power will, unless you act. The $38 trillion time bomb isn't coming, it's already here, and it's ticking.